My name is Ismasewa Kabo from FX Kampala, and today I wanted to introduce to you news trading. But before we come to trading news, I wanted us to first get to know what basically news is. Well, trading news is basically trading major events or major indices or figures that are economical that have affected different economies effectively. Now, before we can start trading news, all we need is accessibility. Accessibility means that where exactly are you supposed to get this information from? And today more than ever before, we are getting resource sites that are providing this information for free. Now, briefly explain to you the whole concept in the layman's understanding. What basically news trading is all about would now be like, for instance, when we look at the unemployment figures. When the unemployment figures are released, for instance, for the United States, for that of the previous month or the ongoing month, we look at these figures, and through the comparison of the other previous month before the current one that are being released, when we do a comparison through those figures, we can tell how the economy is apparently doing. When the apparent figures of the unemployment rate have increased from that of the previous, then it's from this that we can tell that either the economy is doing well or it's doing bad. Now, when the economy is doing badly, investors are coming out of the market or are going to come out to forget about buying this particular currency because it's no longer gaining value because of simply this factor. So news can be figures, it can be a report that is released. Here we are for our 20th rule of the deviation. First and foremost, 20th rule of the deviation is a strategy that says that when the difference between the actual figure and the forecasted figure is more than 20% of the deviation, trade in the direction of the deviation. Now, someone would ask, what is the forecasted figure, what is a previous figure, and then what's the actual figures? Now, I'll give an example. For instance, when we are trading news, we're looking at major factors. Which factors are economically affecting different economies? When they affect different economies, they are literally as well affecting their appropriate currencies. For instance, we're going to look at the news which is worldwide traded, which is called the NFP, the non-farm payroll. It measures the number of people that are unemployed, or the employed sector, or the number of people that are employed in the United States. Well, I'll have, for instance, this is NFP. NFP stands for non-farm payroll, like the very way we see it. So this is a site where we get our information from, or it can be called a resource site. So it's from this site all news that are to be published are indicated. But then we have three kinds or categories of news. There is that news that does not impact the market, but its reports or its figures are released, but they never impact the market. Such type of news are normally yellow in color. The other category of news that we have are orange, and such kind of news, or they are color coded orange. And this news is not so impactful, but it's not so impactful, but color coded with an orange color, meaning that when we are to be news traders, we're not necessarily interested in the two of the mentioned color-coded flags or news that is non-impactive or less more impactive, like we've just seen. Now, the important news that all news traders should pay attention when they are trading news, whether they are news traders or they are technical traders, because for you to do the analysis, it's always very important to also first look at the fundamental side, which fundamental carries 20%, because you may have made your strategy clearly and very late, but because of the lack of information that you may have regarding trading news, at the end of the day you may result into a loss if you don't know that something may be taking place at the side of news. That's why I'm saying that for every trader that is in position to trade, whether a technical trader, whether a sentimental trader, they should as well know this resource site This resource site is called Forex Factory. Just go to Google, type in Forex Factory. Having reached on Forex Factory, you can clearly go to calendar. So it's from this resource site that we get all our information, all the news that is to be released, all the figures that are to be released affecting different economies. For instance, we are now looking at the NFP. Let's see how you can interpret such kind of news. Well, the resource site provides you with the currency or the economy that is to be affected. Probably if the United States dollar is to be affected, it automatically means that the US itself or the United States of America is going to be affected. Now, what the source provides you, it provides you with the information about the time and the date when exactly the news that is to be released, because the moment this news is going to be released, it either chases away the investors or attracts the investors. When it attracts the investor, it means that investors are coming into your country and they have to exchange for whatsoever currencies they are having, fact being that they are from different economies, to demand for the US dollar. And the moment they demand for the dollar, it increases its value. So that's why these figures are very, very important, and all investors are out there looking out at these figures. Let's see. The resource site provides you with the date, that is 15th, for instance. It provides you with the time, and it provides you with a currency that is, or a country that is to be affected. Then it also shows you which category where exactly this news follows. Is it impactive? Is it non-impactive? Is it medium impactive? Or is it at the middle side, or is it in the middle? Now, it shows you also the news. So such kind of news that are color-coded with red are the ones as we call the fundamental indicators. They are basically economical factors that are affecting the markets. But not all. We look at specifically those that are impacting or influencing the market, because they are characterized of long sharp movements in the markets, volatility, high volatility, and the velocity is high, meaning that they are equipped or they come with a lot of pips, either in an upward directional movement or in a downward directional movement. So let's see how we can interpret our news and then see how we can instill or implement our 20th rule of the deviation strategy. So this is how I trade it. This is how I trade with this strategy, or this is how I trade news with this strategy. Now, having looked at the news, I have to first make sure that the news is red in color, meaning that the news is going to be impactive. Secondly, if I'm not sure of whether exactly this news, okay, it may be impactive, but I don't know how exactly this news may be treated. What do I mean by this? Because when it comes to unemployment, the unemployment, if you're doing a comparison between the previous figures that were released of unemployment of the previous year or previous month, can be year, can be month, but when it comes here, we're looking at the previous month. So if I'm doing a comparison of the previous month and the most following month that has passed, whose figures are currently released, when I do a comparison and the economic factor or the economic indicator I'm apparently looking at, let's say unemployment, if today the figures are high of the most recent currency, it will mean that the unemployment factor has affected this economy, meaning that today we are getting so many people that are unemployed than previously. But then if news is the GDP, because GDP is also another economic indicator that is impacting. In other words, it always comes with color red coded flag. Now, when we are doing a comparison, for instance, of the GDP, and this time round we have more figures than the previous figures, it will now mean that we have to treat such kind of news differently. Why? Because today when we have more figures, then the currency tends to strengthen, which wasn't the case when we were treating the unemployment. But for the unemployment, for the previous figures to be high as compared to the previous, it would be bad. Whereas for the GDP to have more figures of the current for the current month or the most recent month having more than the previous will mean that the economy is doing well. So when we are looking now at the non-farm, we say non-farm specifically includes 80% of the people that are employed in the United States. In other words, excluding the people that work from the farms. That's why it's called the non-farm. So all this, if you don't know anything about the news that has been released, all of it is here. Okay, they tell you the change in the number of employed people during the previous month, excluding the farm industry. So that's what I've just told you. So it's basically shows the number of people that are employed in the United States. So the other sector about this resource side is basically the indexes or the indices or the figures that are released, because these figures mean a lot. Now, this red figure of the non-farm, or this column, represents the figures of the previous month. So, meaning that the people that were employed in the United States previously, there were 20 million people previous month. And then, what we expect, or on this show, we have the figures that are expected, the figures that are released by the analysts, sometimes which we call as the consensus figures. These are out of the analysts in the market. They can as well produce their result and show to us that according to us, we are expecting the figures to come to be like this. Let's see. Then the actual figures are basically those figures that are released exactly when at exactly this time of the news, at exactly 8, because that's when we expect. So these figures are released. So it's from these figures that we can do the comparison and see. But then, before this time reaches, we always provide it with the previous figures and the actual figures. That's why the 20th rule of the deviation then comes in immediately after this news has released. That's when we talk about the actual figures and the forecasted figures. So we're doing a comparison. We are saying that when the difference between the actual figure, which is 2,509,000 people that are actually released as the number of people that are employed. So we do the comparison, and then this time round we are not considering the previous thing, because we now want to consider the forecast, because of the fact being that when we are trading, we trade based upon expectations. That's why we shall not take the values of the previous month. So we are taking the forecast, because we are trading, every trader trades based upon the expectation. So I will forget about this, because this has been released. I have the current or the actual figures and the forecasted figures. So all I do is do a comparison or subtract the actual and the forecasted figures. Now, if the difference is more than 20%, okay, of the forecasted figures, then we expect to trade in the direction of the deviation. Let's first calculate and see how we can practically do this. Then we can come back on the blackboard. We can come back on our platform. Let's first do the calculation from the board. Now we have said we're going to do this practically. Let's first see how does the 20th rule of the deviation states. The 20th rule of the deviation states that when the difference between the actual figure and the forecasted figure is more than 20% or 20% deviation, then trade in the direction of the deviation. What does this all mean? This means that, let's say, we'll give an example. Let's say if our forecasted figure is basically 100, okay? Of course, the previous figures are already there. The previous, let's say 50, okay? And then when the actual figures, when the time of news comes, the actual figures are released. So for us, with the 20th rule of the deviation, we compare, or we do a comparison between the actual and the forecasted figure. Reason being, it's because for every trader that is trading, they are based on expectation or speculations. Right now, let's say when the actual figures that come, we expect the figures to come here when they are more than 20% of the forecasted figures, then we are supposed to trade in the direction of the deviation. In other words, we are supposed to buy because the direction of the deviation is a positive direction. Okay, so it means that we also supposed to buy that particular currency. This is what it means, that we get 20% of the forecasted figure. Then when we get 20% of this, we come with a 20. Okay, I'm giving an example. So we get a 20. So this 20 becomes our deviation. So it's this deviation, we are looking out for the values that we may expect for the actual figure to be. So we expect that if the actual figure that comes here, it is more than 20% of the forecasted figure, then this means that we are supposed to buy. So if the figure that comes is more than 20% of the forecasted figure and above, we are supposed to buy that currency. And then contrarily, if the figure is less than 20% of the forecasted figure that is expected to come and below, we expect to sell this currency. For instance, if a figure comes here and it is 120 and above, we are buying the pair. It can be 130, it can be 200, it can be 300, it can be 800, it can be 1000. So for those figures, we are expected to buy the market. So this is how we do it. The moment news has been released, we wait for some few time to volatility to reduce. Let's say, for example, for 15 minutes. Having done with the stabilization of the markets, then we come in with our trade, we calculate the lot size, because the values that we expect here tell us what exactly we're supposed to do. We may either buy or sell. So let's look at the side of selling. For you to sell, you're expected to get either 80 and below. So the values for us to sell of the actual figures that we may expect, they can be 80, they can be 70, they can be 60, they can be 50, they can be 0. So when these values come and they are in between 80 and the values that are below, we expected to sell that currency. So what if, then the question may come out, and it is, what if the values that come are in between 80 and 120. For instance, if the value comes and it's 100, or it can be 110, or it can be 105, what are we supposed to do? Then all you're supposed to do is to forget about that market and you wait for another perfect market. So having noticed, for you either to buy or sell the market, then it's something that challenges most of the traders. Here comes in how to treat the exact currency when it comes to trading a particular pair. Now, if this news was for USD, and you are literally looking forward trading the US dollar, and the news that has come, all the figures that were released are for a buy, let's say it's 130, then you are supposed to be buying the US dollar. So if you're treating USD JPY, for instance, it means that when you come to this, for you to be in position to buy, and because this is expected to gain value because of the news of 130 that has come out, so we expect to buy the dollar, and automatically we will be selling whatsoever currency that will be on the court side. So it means that we will be buying the market because we expect this market to go up. Then on the other hand, when the US dollar was in the court side, then it is the opposite of this. Thank you very much. Subscribe for more YouTube videos. Contact us for the link below or on the contact in this video if you really want out to learn how to trade forex, how to trade cryptos, how to trade all instruments, let it be commodities, stocks, and so on and so forth. If you want to learn, contact, don't hesitate to contact. For more videos, you subscribe on the link below such that you get so many tutorials, or you display, or you're in position to get the rest of the videos that we've released. Thank you very much. I've been Isma once again. Bye bye.